Welcome everyone to the final day of the Phenix Virtual Investor Connect. I hope you've all had a great 3 days and fruitful meetings with one another. There have been over 230 Investor Connect meetings between investors and fund managers over the last 3 days, but we're not finished yet. My name is Jack Heapey, and I'll be your host for today's final webinar, where we'll deep dive into impact investing within private credit. As more institutional investors are increasing their commitment to impact, with portfolios increasingly eclipsing the multi-billion mark, a range of asset classes being utilized within both private and public markets. What role does private credit have to play within the institutional impact portfolio? In this panel, we will discover whether private credit as an asset class can offer that sweet spot between risk, return, and impact, and also explore whether the extent to which it can be a financial and impact diversifier. Secondly, we're going to explore the depth and range of social impact that's possible within private credit. And this is particularly important at this time, as it's becoming increasingly evident that the lowest income communities are being disproportionately affected due to COVID-19. And finally, we'll address the challenges of scaling private credit strategies so they can digest the institutional capital that is required. And joining us today, I'm pleased to introduce you to a panel with a wealth of experience within private credit and impact investing, both from a European and North American perspective. So firstly, we have Mike Lohmeier, who is the Chief Investment Officer at Impact Community Capital. Michael is responsible for developing and executing the investment strategy and structuring new funds, currently managing more than 1 billion of investments for major institutional investors at Impact. Prior to joining Impact, Michael spent 19 years in commercial lending and investment management, including 12 years at Westpath, where he was responsible for the oversight of its 22 billion portfolio. Secondly, we have Mike Moran, who is a managing director of real estate at Allstate Insurance Company in the United States. Mike manages Allstate's commercial real estate investment portfolio, overseeing all aspects of real estate debt and equity, private asset acquisitions, and portfolio management for the company's commercial mortgage loan origination program. And finally, we have Kostis Tselenis, who is a managing partner of Swiss Impact Office. Kostis has managed diversified impacting portfolios of private and institutional investors into the hundreds of millions of euros, and continually helps to shape the impacting sector here within Europe. So welcome to the three of you, and thank you very much for joining us today.
Thank you, Jack.
Now running throughout this this webinar, we're going to have a poll where we will see which markets do you target within your private credit impact allocation, and that's developed markets, emerging markets, or both. So yeah, I'd love to hear your answers to that, and we'll sort of touch base on that poll later on. So firstly, thank you all for joining. I really want to start this webinar by really fleshing out, so what are the benefits of private credit for the institutional impact portfolio? And Mike Lohmeier, I want to hand the sort of mic to you first. Can you explain to me why institutional investors should have private credit in their portfolio, and obviously from the perspective of impact?
Thank you, and it's a pleasure being here. I would say, at first blush, I think the best answer is because it gives you control. Gives you control of the return streams, and in the case of our investors, the impact you'd like to make. In today's low rate environment, there are attractive opportunities in private credit, primarily because interest rates or the yield that you can get on those investments is higher. With the current investment we were putting together, does 2-year loans, and with the 10-year treasury at 88 basis points and the 2-year treasury at less than 20 basis points, there's an opportunity to get some attractive yield there. I think the other part of it, which is really important, and I know some of the other panelists will probably allude to it, is typically these are uncorrelated return streams, which means that they're going to be a diversifier in your portfolio. And that's an attractive investment to have something with yield that adds diversification within the portfolio. And so that's what we're seeing. And we continue to work with our investors to find that right risk return model for them, and that provides the impact.
Thanks a lot, Mike. And Mike Moran, I know as sort of at Allstate, an insurance company, you are sort of looking at affordable housing, having exposure to that in your portfolio at the moment. Can you perhaps describe sort of your journey to looking at within private credit? And just shed a bit of light on that.
Yeah, absolutely, Jack. And again, thrilled to be here and share our story and our approach to impact investing. Look, this is a very hot topic across the investment management and insurance industries, absolutely. And the U.S. is somewhat catching up to the rest of the world here, but it is front and center for Allstate as an organization, and that is implementing a whole host of ESG initiatives across the enterprise, from how we look at insurance and manage the insurance book, run our facilities, run our operations, and within our investment portfolio. And so I'm part of a larger group within the enterprise to advance ESG broadly and responsible investments, particularly within the organization. And as we look at it, private assets, of which we're a part, I run the real estate group, is a really unique way. It affords us an ability, as Mike said, to sculpt investments and a profile that aligns with what we're trying to achieve within the portfolio in a way that you can't really do as well in private markets. So we can identify themes, responsible investment themes that align with our broader enterprise objectives. Things like equity and housing is one of those that aligns with what we're trying to do as an organization. It aligns with our brand as a P&C insurer, and it's actionable within the private markets. And so as I think of my business and how I can contribute to responsible investing and ESG initiatives to the enterprise, align with the equity and housing theme. Private credit, as you describe it, I call it low-income housing mortgages and lending is a really, I think, attractive way to do it. And that's what we're doing. And so we're partnering for one with Impact Community Capital, but in other parts of our business, our direct lending business, we target opportunities that where we can provide credit to owners, developers, sponsors of housing that's curated to affordable tenants. And it matches our liability stream, meaning these are durations and yields that are really competitive with the broader fixed income and private credit market. So there's a place in it for the portfolio. There's a really attractive risk-adjusted return if you can get to the types of credits that you like and underwrite them, and again, sculpt the profile that you like. Again, available in private markets, less available in public markets. And if you have that expertise or partners, then it's a really attractive risk-adjusted return against our liabilities that also has a really strong social benefit that we're proud to promote.
That's very interesting on the question of liabilities there. So it's actually coming from your traditional portfolio, as impact investors would call it, but it's coming from your normal portfolio, this exposure. It's not something where you've said this is our impact bucket per se.
Absolutely not. And that's very key, is that we've chosen sort of a ESG integrated approach, meaning we integrate ESG risk factors and return considerations into our traditional allocations and underwriting as part of our regular way investing. Now it's a significant consideration, but we don't have a dedicated impact portfolio where we're only doing X, Y, or Z. We may get there in our journey within Allstate. I think we ultimately will, but we're not there yet. And where we are today is what we call ESG integrated rather than ESG directed, which is what I would say we have a separate sleeve or allocation or portfolio for specific responsible investing or ESG themes. Right now, we're integrating it into everything we do. We're educating ourselves on where the best risk-adjusted returns are and how to do it, and be sensitive to our liabilities and our fiduciary responsibility to our liability holders and everybody else. We are, I think, still at the very early stages of this journey. The company, the industry, the sector is absolutely going that direction. We just need to be thoughtful about how we deploy it and how we get more focused, more purposeful in what we do, and we're getting there. So, but today I'm proud of the equity and housing theme that we've developed, and the use of really low-income housing lending as a very low risk, high yield private sector that we can attach to, because we have a real estate focus and capability within the organization, and because we have really strong partners who do that specific niche of the market very well.
Yeah, that's a really fascinating insight, because I think certainly from the conversations we have, there's a lot of insurance companies that are entering into impact and perhaps don't know where to start or which asset class to get their feet on the ground with impact. I think private credit, like you're mentioning here, really offers that chance to dip your toes in the water, and also then have a theme that is valuable to the company, and in obviously your case being affordable housing. Now, Kostis, I want to bring you in here. So obviously you've got a lot of experience talking with institutional investors and helping them entering to impact. From what Mike's saying there about sort of they're using private credit to come into impact and get their toes in the water, if you like, how do you sort of see private credit being useful for institutional investors to make impact investments and start the journey?
Absolutely. I mean, already Mike mentioned a lot of the rationale behind it. Maybe what it makes sense here for me is to give the wealth management perspective or angle. And if we look back of what was available for impact-driven investors 10 years ago on the debt side, we will see that it was mainly developing world linked and microfinance, and asset class that developed very quickly, and it was very interesting with a very high and a very impactful strategies per definition. But what I've been seeing in recent years, in the last 5 years, for example, is more and more products coming to the market around debt strategies, and including different geographies, asset classes, themes, etc. And this evolution is, I feel, supported by existing debt strategies that are transitioning to ESG and eventually potentially also in impact. Mike Moran mentioned that direction that they're following right now. So from a wealth management perspective, we see more, and that gives the opportunity in a fully diversified client mandate, institutional investor mandate, to be able to go more the direction of the mainstream investments in the portfolio, but with more impact. So right now, this kind of the percentage of the total investor portfolio or the capital that was meant to be allocated to impact was relatively small. By seeing this transition with new products, new strategies, new asset classes, we see that they can have this risk-return balance profiles with more debt products. I think this is a major change that we see is happening in the last 5 years, but also from the investee perspective, because usually, again, we have connected impact debt and impact private credit with microfinance and developing world. If we take a look in Europe, and not only peripheral Europe, but also Western European countries, with the COVID situation, if you allow me to connect it, despite the state progress, we've seen a tremendous number of micro and small medium enterprises that actually still, they never had access to the banking system, and they still don't, despite the programs, the state programs that were COVID related. This is a gap that a lot of product managers right now are trying to fill in, either with factoring or with SME lending, and I feel that debt is an important part of it. And if I can add something more, it was mentioned a little bit already. From the capital owner's perspective, the ones maybe that are still a little bit critical, they're starting with impact investing now. We know that we're living the years where the demand for impact investments is higher than what's actually out there or what is accessible, because there's not so much visibility in the market. Still, to the degree that it would be necessary, especially for institutional investors, we see that this gives them maybe an opportunity to start in a safer way and test the waters. A lot of these strategies also are linked to open-ended evergreen products, which allows also the investor, again, to allocate capital over years, as it's an evergreen structure. It's a very interesting strategy. I call it the semi-liquid impact strategy, and it has tremendous potential also probably for the asset management strategies of financial institutions in Europe and the US and globally. And this is only possible with debt strategies because they have, per definition, a certain degree of liquidity in their profile because of repayments, interest payments, etc. And of course, we have more in this impact universe in terms of maturities, asset classes, as I said before, etc. So it adds more wealth to what somebody can do to have a balanced, diversified portfolio in impact nowadays.
Interesting to see that from a risk return point of view, that there's more impact products becoming available now for institutional investors to tap into. That is obviously needed, that wealth of product for investors to allocate sort of large sums. Yeah.
Absolutely. And a lot of them, sorry to add that, still probably don't have the institutional investor qualities that are necessary, maybe in size, governance aspects, regulation. But as they grow, I think that we will get there eventually so that we have a broader palette of investment opportunities for institutional investors as well.
Fantastic. Mike Lohmeier, so we're speaking here a lot about the risk return, very important for institutional investors from a long-term perspective as well. And now we look at different asset classes that investors can invest in with an impact. You think of private equity, public equity, and obviously private credit is 3 examples. I want to sort of know from you, to what extent can private debt provide early performance signals in the portfolio, perhaps in a way that private equity or venture capital cannot?
So in terms of performance, I mean, I think getting the early performance signals, and Kostis alluded to it, right, is there's a natural liquidity in the structure of a lot of private credit, in that you're getting, the payments are occurring almost immediately after you make the investment. They have maturity schedules and repayment schedules that can be customized. And so what you're in a feedback loop then, right? Because you're seeing how that operation's going. You're writing into your documents a certain element of surveillance, reporting and things like that. And so private credit gives you that opportunity to customize it too. So if you're, in our case, we finance a lot of affordable housing. We want to make sure that they're serving the targeted markets in terms of the incomes of the tenants, as well as, the performance of the property from an operating perspective. And you do have, your finger on the pulse of those investments, on a monthly, given the payment schedules, quarterly in terms of the reporting schedules. And so it does give you that ability. It also gives you the ability because you're getting capital back. Your overall portfolio can be managed in a way that's responsive, right? Okay, maybe that wasn't working the way we expected, so you tweak the model. As you reinvest your capital, you're going out with a slightly different, improved way of looking at it. And so it does give you the flexibility and really that ability to be nimble and flexible as you continue to invest and reinvest over time.
Yeah. Thank you for that. And so, Mike Moran, is that flexibility on sort of having your finger on the pulse of the portfolio within private credit, is that an important thing for you as you sort of look to enter into ESG and impact?
Absolutely. Hey, listen, I'm in the private markets, and one of the reasons why we like private markets is because we have control over the investment, as Mike said earlier, and you can again curate a profile that fits your needs through your direct underwriting and investment, and I think that's a very significant benefit as the world changes. Look, today the location and type of space that people need for housing, let's say in our affordable housing theme, is changing. People want less density today than they did before, neighborhoods with less density, maybe larger spaces as they work from home and their kids are schooled from home. And so we can move our capital to those themes to promote better equity in housing for individuals who don't have those characteristics today. So things like that is important to us as a private investor, for sure.
Very good. Thank you for that. Yes, so that I think that's given us a good insight into some of the sort of reasons why institutional investors should be considering private credit with an impact. And I want to sort of turn the attention to sort of looking at the various different social impacts that can be made within private credit, and obviously particularly with affordable housing in the US, given its strong focus, obviously, of impact community capital. Mike Lohmeier, do you want to just sort of discuss a little bit sort of how deep the social impact that you can make within your strategy? And I particularly want to frame it in the context of sort of the economic damage that we are seeing now amidst COVID, and how actually does the social impact you're making mean your total investment strategy is better off?
Certainly. And so I'll just start with, obviously this has been a very interesting year, particularly in the United States. So with COVID and with, the heightened concerns around racial equity in the United States, I think it's important to keep in mind that these problems existed before 2020. So when you look back, there were studies done most recently in 2019. There were only 36 affordable housing units for extremely low income every 100 low income units. So that's about a third of the demand was being met. Extreme supply and demand mismatch, which from an investment perspective is attractive, but from a social perspective is disappointing. And that also disproportionately affects not just low-income people, but people of color. So on average, Black and Latino workers in the United States, the median wages are 25% less than white wages. And they're paying, essentially more of that income on rent to live, just to get by. And so an example of that would be, 40% of Black and Latino households are spending more than 30% of their income on rent. So you have this deep social issue that housing is part of the solution, right? If we're able to create more affordable housing, preserve affordable housing, low-income people of all races, but particularly Black and Latino households, will have more disposable income. And what does that mean? I think the real element of it is that's the first order effect. You can put more money into low and moderate income and people of color's pockets, but that has secondary effects such as educational outcomes, particularly for children who are in stable housing. So once somebody does have an affordable unit, their tenancy is typically extended. They're not likely to move from it. And so having educational outcomes is closely tied to stability in the housing. Also, health outcomes are tied to it. It's sadly, asthma for Black Americans is 3 times higher than for white Americans because of their housing conditions, because of the sanitation in their housing conditions. Providing safe and sanitary and affordable housing helps relieve some of those problems. And, from a business perspective, we like to talk about this a little bit, but more affordable housing produces disposable income, which, if you think about it, it in turn turns into more consumers buying products and services, right? And they're buying staples, they're buying more healthcare, they're buying more the better food, they're buying transportation services. But it also is a boost to the economy because it's not all being locked up in housing. So that's some of the first order and second order effects.
I find that really fascinating, sort of looking at, particularly from a developed markets perspective, sort of how, let's talk about a lot in private credit, that basic needs and sort of jobs are a big sort of social impact that's made. And typically investors think of that view in emerging markets. We've just got the poll answers back, and 67% of our audience have said they're looking at private credit within emerging markets, and 33% have said both. So no one in our audience is only looking at private credit in developed markets, but what you've described there gives you a sense that actually this asset class can be have a very big catalytic effect on some very important needs that need to be met. So yeah, I think that's very interesting. Perhaps Kostis, do you want to shed a bit of light on some of the sort of different social impacts that you see within private credit?
Yeah, absolutely. Again, I'm going to start with a microfinance example that I mentioned before, right? It had a major impact in early days, consumer lending, which is how it started on the first place. But we've seen also that impact investment managers started looking more the direction of SME lending. And I feel also that should be gradually the evolution of microfinance. And then if we disconnect the developing world apart, and we have to eventually, because I think there's a lot of misperception still in the investor community of what impact investing is, and a lot of people still, I'm back in Zurich for a couple of months, and I reconnected with a lot of friends and colleagues in the financial and the investment space, and still there is a misperception of what impact investing is, and the connection to the developing world is still very strong. While nowadays, as Mike Lohmeier has mentioned, you can do affordable housing US, and that has a tremendous impact as well. So the impact profiles are not getting diluted just because we're including strategies in the developed markets. From an institutional investor's perspective, again, this adds more options, as we said before, therefore they can also expand the impact exposure. They can increase the impact exposure much more. Now, if we see it from the investee side, and I started saying that before, but I can expand a little bit on that. If you see the studies and the reports and what we hear from the market, from the deal flow that we're getting and from the companies that we're listening to, there is a very big part of that in potential investment universe that does not need equity. They need working capital, different forms of working capital, different forms, short-term lending, factoring even, to be able to advance and progress. And actually, in many cases, they need it even more, because the debt financing has also different characteristics. It's a different due diligence process. It can be done quicker. It can be done in a revolving way so that it can fit. It can fill the gaps, the liquidity gaps that an investee can have, a company can have over time, especially in situations like the current one, the COVID situation that we're all experiencing. So quick capital, short-term capital with the respective terms was absolutely necessary. We've seen amazing examples from fund investments that we have and case studies where companies literally stayed adrift because of such solutions. And there was nothing with their business model. It was the lockdowns that have triggered this artificial crisis inside the company. So we see how important that is and what major impact such strategies have. And if we give a couple of new examples of that strategies, I feel, again, from the investor's perspective, we're adding more themes, affordable housing, green real estate, even renewable energy infrastructure that was in early days approached by institutional investors only from the equity side, because in most of these countries, you had the debt finance, you had the bank financing for solar development or wind development. But we see also in many countries that these schemes are not so generous anymore. We see the institutional investors and the private investors wanting also to get a piece of the pie on the debt financing part of renewable energy infrastructure. And of course, green real estate, which is highly interesting also to get involved on the debt side. And another final example, I think it's trade finance. I started relatively early with my exposure in this asset class, and it's pure debt. It has also very good liquidity characteristics, monthly, for example, or even weekly in some specific strategies. Very short term, very diversified, and we see a lot of product managers there coming from the traditional trade finance segment, developing ESG and impact strategies in trade finance. And if you ask an institutional investor, trade finance and impact, is that even possible? They would not even put it in that kind of exceptional risk, exotic part of their portfolios, because it's trade finance, it's something that they know, and they can have also an impact exposure in the meantime. So I feel that on the impact side, it's tremendous. And if on the trade finance part, what can we say? We're talking about financing of value chains, export, import, production. So if this is done with impact criteria, we can all understand, because that's also the link to the developing world, we can all understand what kind of social impact that can have.
Very interesting. And one thing that sort of touched upon me then was thinking about the level of control of social impact that you can make that perhaps you can't have within other asset classes. And you sort of alluded to it there, that some companies need debt. It's not possible to give them other forms of financing because, you just will not have the outcome that you want. Mike Lohmeier, do you sort of get a sense of that? Is in affordable housing? Do you think the fact that you're giving debt and credit means that you can make that racial equity and you can have your communities flourish?
We do. And there are equity opportunities. They're different. They have a different investment profile. And in many cases, it could be the same investors you'll find in private credit, but the return profile is slightly different in terms of an equity and credit. I think what we like, as Kostis was alluding to, is being able to tailor the product to the impact story is helpful as well. And so I mentioned earlier, we have a shorter term product because that's really tailored to preserving existing affordable housing, and that has a very defined capital need. for short-term lending, whereas equity investors in those similar properties are looking for a longer hold period. And so you can meet a defined impact need. You can meet investors at a different point in terms of what the characteristics are of the investment. And as I said, in some cases, it's the same investor. It's just a different bucket for them or a different need that they have that they're expressing in that investment.
Right. Interesting. I think sort of tailoring impact to risk return is a big sort of topic at the moment within the impact world. And Mike Moran, do you get a sense if that's the case, that the better your portfolio performs on risk return within affordable housing, you make more of an impact with the level of affordable housing that is ultimately being offered? Do you see that sort of that happening?
Yeah, absolutely. I mean, that's sort of a gating threshold issue for any insurance company or institution, which is, you need a market rate of return, you need an attractive return given the risk that you're taking, and the more attractive return, the more dollars get allocated, and the more impact, therefore, you can make. And the question of how do you characterize that return, right? Is it all dollars, or is it somewhat, social impact plus financial return equals, the right risk-adjusted return? We're not there yet, but my sense is that the industry is developing tools and getting more comfortable with, hey, so long as there's a acceptable threshold of return and a financial and a non-financial benefit that we can quantify, measure, and add to the the alchemy of risk-adjusted return, that capital will be allocated more robustly to those sectors that have that dynamic. But the question of measuring the impact of having standardized metrics, having the ability to divine out what and have really confidence in the impact that you're making is, quite frankly, something that the industry needs to work more on if we're going to get to this world of both financial and non-financial returns in the risk-adjusted return equation.
And how do you get to that point where you have a better sort of reporting on impact, particularly within sort of private credit? And perhaps you want to talk a little bit about how that works with impact community capital and yourself, because what I'm interested is some investors that are looking to come into this space that don't know perhaps what to report on impact, or would like to report on certain things, but is the manager willing to do so? How has that conversation gone between Allstate and impact community capital? Was there been challenges?
It's no. So I think the challenge isn't our sponsors' willingness or interest in providing that. They are way more motivated to provide it. It's the availability of the data. It's getting it out of the underlying assets. It's tracking it. It's making audit, making sure it's sort of defensible and standardized in a way that we can all feel good about, we can all have faith in it. And so I'm going to hand that over to Mike, just because I don't want to have to answer the question.
Nice start.
No, I agree with what Mike Moran just said. In a sense, there's a strong willingness at all parts along kind of the chain of creation of these investments to gather more impact data, to have it be more meaningful. I think Mike alluded to the challenge, which is it needs to be, accurate and usable. And there's a technology issue. You need to have a system for being able to aggregate it together and then make useful insights from it. And I think the biggest challenge is that particularly in property data, but also with consumers of operating businesses, there's a lot of different consumers. There's a lot of different tenants, and they do, their circumstances change. And so while our industry is really good at measuring output, so we've been doing affordable housing for over 20 years. We've been measuring impact. It started out, it was like, oh, we financed a certain number of units. And as that journey's gone on, it's, well, what kind of units? Who are they serving? What are the additional services provided at that property? What is the neighborhood like? Have we improved the neighborhood? And then you get to, well, we improved the lives of the tenants. And that's the question that's really hard to answer, because you need to know a lot about the tenants to do that. And you need to know it over time. And so we've moved from very simple measures. How many dollars did you put in impact investing? That I've been in impact investing for over 20 years myself. That was the measure. We financed $1 billion. Everyone's like, wow, that's great. You had no idea what the actual impact was, but that's what you could measure. So we've gone from that to units, and we've moved. It's a progression. And I think the holy grail, for lack of a better word, is being able to measure truly the impact on the lives of the people that you're serving. And some owners have done it. They've got a much closer access to that data. Researchers have tried to do it with panel studies. It will become more and more part of what investors are expecting to see, and the industry will develop that solution. But it's a challenge.
Do you see a situation where you're looking at sort of having your finger on the pulse of sort of the returns you're making within this asset class? Do you see this asset class offering any sort of difference in reporting or the regularity of impact reporting? Do you think that that is easier or harder within private credit?
Is that question for me? I'm sorry.
Yeah, Mike Lohmeier.
Oh, I'll let Mike Moran answer this one. He seemed to be interested in jumping in.
So, with regard to credit within real estate, there is really no public market alternative. I mean, you've got CMBS and, there's not a good public market alternative. So within private credit, the fact that you can connect, partner with people dedicated to the space who have a business model around promoting affordable housing and measuring the impact that you're making is I think unique to a private credit solution for that. We've got ratings on all of our public bond, ESG ratings and all of our public bonds, and we get we get that information within the public space, but it doesn't afford us the detail or the next level of impact assessment and reporting that we would want in a dedicated strategy focused on something that aligns with Allstate's broader ESG areas of focus and its brand. So I think it's really unique to these kind of bespoke private relationships where you can dedicate capital to a specific strategy, work with your partner, your asset manager to create the metrics and the impact assessments that you need to have confidence that you're achieving the goals that you set out. I don't know how, I think that's pretty unique to private assets generally, whether it's credit or equity.
That's interesting, yeah. And Kostis, do we think that obviously the microfinance, we're looking at some strategies that are now into multi-billion strategies in microfinance in emerging markets. What are the lessons we can learn from that process of getting the right impact metrics back to investors that they want to see? Can we learn anything from the microfinance world that perhaps now developed markets can learn something from that?
Absolutely. I think, first of all, maybe a general comment, the whole exercise about impact framework, measurement, and reporting is difficult. And sometimes we spend a lot of time discussing exactly this, and maybe sometimes a little bit more than we should, because we also have an investment portfolio to take care of and new investments to do. But I understand the necessity, and within that core impact investing community, the global impact investing community, of course, an impact framework and metrics and reporting is almost mandatory, but we shouldn't see that component as being something static. It's more dynamic. Once we know as investment managers that the core business model of the potential direct investment or the core investment strategy of the investment product of the fund is fully aligned with impact and addresses a global social or environmental problem over time, then that's enough. And then usually what we do, because we have the expertise, is either connect the company or the fund to some impact experts to start monitoring more and more, collecting the data, defining the themes, defining the metrics, and over time, and that's why we should see it, we should look at it as a dynamic component, over time develop more and more, report more and more, to the degree that does not make the operations of the investment, or does not take too much time, too much management time just to do this. But it is important to be able to report also for different reasons. It's not only to showcase to an impact investor, yes, that's very impactful, and those are the metrics, so you can show it at the end of the year to your shareholders, for example. But it is also, it gives the opportunity to the company or the fund manager to identify the risks. So the more environmentally and socially aligned a potential investment is, the more risk averse, risk robust it will be over time to any risks, not only social and environmental risks. So I think that it's a useful exercise. It's expected from investors, institutional and private. Absolutely. It's a dynamic component. It's a development. It's an evolution process.
Very interesting. So really embedded within the risk return when looking at that.
And the connection, absolutely. The connection makes sense. It's not only just to report it so that we can appeal to impact investors, but also to revisit our business model and see where the alignment is and actually reduce the risk profile of the investments. And if you allow me here, this is what we say, the whole debate about lower risks in impact, lower returns in impact investing, etc., I think to a certain degree was not so helpful, because we also should look at the risk return, the risk return profiles. And if we are able, with impact investing strategies over time, to reduce that risk component, then per definition we have better performing investments. And that's why I feel over time in all asset classes, even the ones that do not have balanced risk return profiles yet, we will see that the impact investing portfolios will actually perform better than mainstream investment portfolios, because of that very parameter and component.
That's exactly right, Kostis. That's how we're thinking about it too, which is, it's not just a return question. It's how do these investments contribute to lowering risk, being more sustainable investments over time. But you have to measure that. We have to prove that out, right? We have to make sure that our asset allocation models incorporate those long-term factors, so that we're allocating capital appropriately to these factors, and quite frankly, we're not there yet, but we're getting there, and we're optimistic,
it's clearly
and we're getting there. We will absolutely get there as an industry. We're just not quite there yet.
That's interesting. It's that feedback loop, I think, really, really fascinating, that the more you can learn from looking at impact means you can reduce risk and ultimately improve return. So I think seeing it as all three together clearly there, important. We've had a question from the audience, so please feel free to keep them coming in. So on this sort of question, so apart from measurement, as a debt provider, how do you manage for impact? And is it possible to sort of engage with the underlying portfolio to do that? Perhaps Mike Lohmeier, do you want to sort of have a first go at that one, sort of managing for impact?
Sure. I mean, I think it's I would say it's actually probably more difficult during the life of the investment to manage impact at the underlying investment, because you have a defined relationship. You have legal documents, you have your debt instruments that define your relationship, and it's structured to be that way. And so it's a challenge. But what you do is you do it up front. You negotiate into those legal documents that define your relationship what you expect from an impact perspective, what you expect from a measurement perspective, how you expect that owner operator to manage the facility or to manage rents, for example. And so I think you have a lot of control up front, maybe more so than in the public markets, right? Because you're buying instruments that are just out there, and somebody else, another buyer, might have a lower threshold for impact than you do. So the standard is kind of like, they'll race to the bottom in terms of if they can get capital cheaper with less restrictions, they're going to do that. But in a private credit market, there's not as many other options, and you have that ability to negotiate into that relationship your expectations. And then from a management perspective, it comes down a lot to the reporting and what you're doing with that information.
Kostis, would you sort of say something similar there? Do you sort of see that happening?
I absolutely agree with Mike. You start and you integrate, you incorporate these components in the legal documents before you invest for the transaction. And I think that you have maybe two angles again on how you can increase impact. Per definition, because of the growth capital you're providing, the company will grow. A 1 million revenue company has, a 10 million revenue company has more impact per definition if it's the same business model than a 1 million revenue company. And the second one that we can also do over time is, again, partner up with the management team to continuously improve the impact profile. So do these adjustments that are necessary throughout the value chain of the investment and see, okay, it's very impactful, but can I actually take it to a next level? But again, that's a process. It shouldn't be something that you do overnight. You agree on some specific targets. You can also legally bind the investee to following these targets and measuring them to a certain degree. But then again, you can sit down over time on a board, for example, on a board meeting context level or with some task force teams to see and identify more areas to increase that impact profile over time. And we're talking here about 5 and 10 years. It's not something that you can do in 12 months.
And that sort of have those legally binding sort of requirements at the start of the investment, and the fact that it is private credit, it's more of a longer term sort of investment in certain instances. Does that mean that it's easier to control and enhance impact within this asset class versus perhaps other asset classes? I think public markets, for example.
Yes, of course, when you're doing equity, it's even on the equity part of the investments, it's difficult to put really legally binding terms on top of all this that we have as investors and put them also, connect them to impact. So what I explained before, maybe it's a little bit ideal, and it doesn't always happen. But I think, again, I said that the basic requirement is that the business model, the core, the heart of the business model of the company addresses one environmental and social issue over time and long term. Now, I think that it is probably on the debt side, it might be a little bit even more difficult than it is with equity to put such kinds of legal binding terms. But again, if you are in a segment, in an industry with a business model that addresses a social environmental issue, and I'm repeating myself, then I think it should be more than enough.
Right.
For a start.
Great. Well, thanks for that. And then Mike Moran, is that something you're looking at sort of putting in? Are you requesting that from your managers, having those sort of legally binding impact covenants, if you like, or is this something that is an ideal, something over the horizon?
Yeah, well, it's an ideal at this point. Look, our approach today is to partner with managers who have a specific impact strategy that aligns with our goals, and we quite frankly delegate a lot of that to them, and that's a key to our success, which is having long-term capital that's flexible. Like we can negotiate and adapt our relationship with sponsors as we need to and as the market dictates. We have a long-term view. We have an impact theme, and so we're partnering with folks who are quite frankly negotiating on the ground with these owner operators and sponsors in a way that gets the impact. Now we hold them accountable for us, but they're going to be in the weeds dictating, and that's something that as a large-scale institutional investor, we need to operate that way for efficiency, and so that's kind of how I think about it.
Fantastic. Thanks a lot for that insight. Okay, final sort of topic of discussion. I want to touch upon scalability. Obviously, institutional investors typically invest very large sums of money when they want to sort of go into certain areas. So, Mike Lohmeier, I want to get a sense from you. How scalable is your strategy? Can it be done 10 times over? Can it be done sort of even more? Could you perhaps shed a bit of light on that?
Sure, thank you. So first, I alluded to this demand for affordable housing in the U.S. And it's incredible in terms of number of units for extremely low income individuals or families, sorry, we need to build about 7 million affordable rental units. If you go to low end, moderate income families, it's about 14 million. So incredible demand, right? So you'd think that's a scalable opportunity, right? That's billions, if not almost $1 trillion of investment on the equity and debt side that's needed to meet current demand for affordable housing. And so the market's there. There are a lot of players in the market that aren't private credit, though. The government gets involved in various ways. We have two agencies, Fannie Mae and Freddie Mac, that finance a lot of affordable multifamily rental. We have the Federal Housing Administration, FHA, which has a securitized product through the Ginnie Mae securitization. And so a lot of the demand is focused and handled by public markets. Those are typically larger deals, hundreds of units. And so what we see on the impact side, and we like it from an impact perspective and an investment perspective, is, well, what's not being met? Where is the scale not naturally there? And it's on smaller deals. It's in smaller metropolitan areas. And so we look to structure products to take advantage of that niche. And if you look at the market for affordable housing in Europe and other places, it's similar, but not exactly the same. For the very low income individuals, the extremely low income, governments provide subsidy. It's called government housing in various places, social housing in the US, it's called public housing. That exists. There's really not an investment case right there, but just serving those incomes and maybe some that are slightly higher, there are opportunities to partner, to do private-public partnerships, to finance units in those same developments to help leverage those public funds. And then if you go all the way up the income scale and you're serving people who are making, let's say, the median income in a high-cost market like New York or San Francisco, that's an affordable housing need as well that's unmet, because they may be paying 50% of their income or higher on income. And others, and I know like at Allstate, they do this, that's called workforce housing. And there's a lot of private capital on the equity and on the debt side that goes into that. One of the things people need to keep in mind in terms of the scale, particularly in the US, of affordable housing, the median renter's income is about the median income in a sense of, actually I should say the median renter income is less than the median income for everybody. Over half of renters are low and moderate income. And so you're serving a need. If you're in social housing or government or public housing, there's a need. If you're in workforce housing, there's a need. We need more rental housing. And so that's the scale of the problem. In terms of meeting that, and I think this is a unique role that we play, and that we've done it for a number of years, is aggregating those small deals through a facility that our investors have provided. We can do a lot of small, high impact deals, bring them together, and then to provide liquidity for those investors, we've gone to the public markets. So we created a private credit strategy that morphs into a public market strategy by issuing commercial mortgage-backed securities, by aggregating affordable housing mortgages into pools and working with the agencies to issue agency-backed securities. And that brings more capital to markets that wouldn't get it. A 60-unit development in Tulsa, Oklahoma is not going to have lenders necessarily falling over themselves to make that loan. But you package that with 50 other loans of a similar size, and now you have something that's diverse and that's investable for institutions who really play in the public markets. And so that's the role that we play. And we think it's a value for our investors, right, to be part of that creation of value. And we look for opportunities to do that. So we do it in long-term permanent mortgages. We're looking at other sectors that have similar characteristics, where there's a high impact niche where you can aggregate assets together and then package them into products for institutional investors at scale. And so what is the scale? As I said, in the US, you could invest billions of dollars in the affordable housing problem in the US and not make a dent. I mean, that's the kind of scale that's available. I think the challenge, as we've talked about, is creating the product, so accessing it with the right risk return profile. I think it's also, there's a hurdle to understanding the interplay between public and private markets. So government entities all along that income scale of renters have their various subsidy programs, whether it be for tax abatements or direct subsidies in terms of low and low-cost capital subsidy, as well as a tax credit program in the United States that provides equity opportunities for institutional investors. And so you have to understand those programs and how they interplay with each other to be active in the space. And that's a real hurdle for investors. And you do need to either buy or rent, for lack of a better word, a manager who can understand that and be able to play in that market. So there are some hurdles to creating scale, but it's there.
That's interesting. So what I'm hearing there is it's sort of having that groundwork, having the years of experience, really understanding the strategy before you can actually scale it. But Mike Moran, what do you think are the keys to increasing scale? Do you think it's that? Do you think it's sort of having the groundwork, having the managers that are really sort of deep in the areas that they're focused on?
Yeah, I think it's two things. I mean, clearly, in order to access these markets, you need to have a capability, whether you rent or own it, to and the relationships in the dedicated resources to understanding the regulatory environment, the local market dynamics. Each in the U.S., each state is different, and the local needs and risks are different. And so having that capability is a hurdle, quite frankly, that all private markets, whether it's impact investing or not, require that sort of capability. And so that's number one. And number two is you need I think to have a very focused approach. It's a wide playing field. It's a wide fairway, and having a well-researched strategy in order to influence, in order to deploy capital and influence the market. You can kind of create your own market if you really wanted to, right? If you're a scale investor looking to make a specific impact, and you find a capability, whether you rent or own it yourself, you have the ability to create that market to a certain degree and capitalize on it in scale. As Mike said, there's an opportunity there. The public or the public markets and the government agencies are not a full solution. The private market absolutely has to be part of the solution. And with institutional, well thought out, well organized capital, with deep capability, whether again owned or rented, can absolutely make a difference and do it in scale.
Thanks a lot for that. And Kostis, sort of, how do you sort of see these sort of scalability sort of conversation issued? How do you think investors can sort of really inject large volumes of capital into this space? And are there any challenges at the moment for them to do so?
Yes, I think it depends a little bit also on the theme. Maybe we can also connect it to replicability. So I think scalability is connected to replicability per definition. Maybe it's easier for project finance related investments. Affordable housing would be that case. I think that we all agree, to start with, we all agree that the social and environmental problems won't be solved. So potentially this is a gigantic market. And if we want to reach in time the SDGs, then we need a couple of trillions still. And we're not there. We're very far from there, actually. If you put together the impact investing volumes right now that we have today as we speak. But so some models are a little bit easier that are project related, infrastructure related, I think. Some other themes a little bit more difficult. Maybe as a solution, the first solution would be institutional quality products. That's what we addressed at the very beginning of our discussion. I have 600 funds in the database, and then if you really look at with institutional investor classes, then you're going to have, for different reasons, a lot of them dropping out of your list. And the size is a very important factor. Apropos, that's why we're always saying as investors, a similar strategy should probably, under that framework of collaboration, join forces and create something bigger, better. If it's exactly the same investment strategy, why have 3 independent product managers, right? And another solution in that semi-liquid space that I addressed at the beginning is exactly the very semi-liquid impact investing products. Because of their evergreen structure, they can allow more and more capital to be accumulated and therefore be able to scale up their activities and investments. Again, it's not, if you the early days of impact investing 10, 15 years ago, it was extremely hard to address even existing demand with high quality investment opportunities. And this is changing, but we're still not there yet. If we would want even to invest 2 trillion in high impact investment profiles, maybe even today we won't be able to. So I think it's evolving. It's evolving. It's still a young market. A lot of people forget this because it's all over the media and there's so much discussion around it and everybody wants to do impact investing. But we're still facing the bottlenecks and the challenges that a young investment strategy, market, asset class, whatever you want to call it, or methodology, I think it's the better description has.
Yeah, I think I totally would agree with you there on the institutional quality products are vital in terms of sort of for us to get there and having the managers that have been in these markets for a long time looking at this space. Well, that brings us to the end of this panel. Thank you so much to the three of you for joining me today. This has been a fantastic insight and yeah, for showcasing your sort of experience in this sector. We really appreciate that. And thank you all for joining the webinar today, for the questions in the Q&A, and for joining the Virtual Investor Connect over the last 3 days. It's been a pleasure to have you. Thank you.